Hello, hello, hello. Happy Wednesday. Welcome back to our live question and answer session. My name's Dave Hall. I'm the prosperity guy, and you may notice something different again this week. I am missing my sidekick, CR Talene. He is on an airplane heading to Hawaii. I'm not sure why I'm the one stuck doing the work, why he's off traveling, but it is for an exciting time for him and his family. His son just graduated not only from high school, but also graduated with his associate's degree. So they're off taking a family trip before his son ends up going and serving a mission for 2 years and ends up leaving the family. So plenty fine to be here by myself. If you have questions today, please feel free to put those in the chat panel. I'll do my best to get to those. With me running both the controls and trying to answer the questions, it may be a little slower than what you're used to when we have CR on here, being able to make sure everything's taken care of and that we can get audio and video and everything else working the way that we need it. So today I am going to go through a number of preset questions that we had during our webinar yesterday called The Changing World of Retirement. If you've not attended any of our webinars, we'd encourage you to go to our website, theprosperityguy.com, where you'll get access to 13 different webinars. We keep adding to that number. My guess is by the end of this year, we'll have somewhere near 20 different webinars on various retirement topics. The one yesterday was a 4-hour class. It is one of our top attended classes when we look at interest from those who are trying to get to a safe and secure retirement. But it is a 4-hour class. We teach it every month. If you haven't had a chance to attend it, I would encourage you to take advantage of one of the upcoming classes. I think our next one is scheduled for June 24th. It may not even be up on our site yet. They're trying to work out all the back end details, but I believe June 24th will be our next 4-hour class. And this is where I take a deep dive into all the various topics that I covered during my other webinars. Now, it's a new slide deck. You're not going to get a repeat of the exact same information, but we do go deeper into the topics we cover, especially my 1.5-hour presentation on getting safely through retirement. It takes a much deeper dive on the topics there. But let's go ahead and jump into the various questions that we have. I'll do my best to get to as many of these as well as many of your questions we can during the next half hour or so as we spend this time together. First question here is from Lynn. If I do a Roth conversion, will it influence my income and qualify my kids' college financial aid? Lynn, yes, it is going to have an effect on the financial aid you're going to be entitled to. So this is something you're going to want to look at. If you're dependent upon financial aid for your children and their college, it may be in your best interest to delay doing conversions. Now, for most people, what we want to do is have these conversions during this period of historically low tax rates. We've got a time from between now and January 1st of 2026, where we're at one of the lowest tax rates we've ever had in the history of America since they were first brought about in 1913. But there are always underlying circumstances. A situation that Lynn's got here with financial aid concerns as we get closer to retirement and we start doing large conversions, it can affect our Medicare premiums. So that's something we've got to look at, all kinds of various issues. And that's why you want an advisor to help you walk through these things, because they're not easy. They can get very complex, and there can be a lot of areas that need to be covered that you may not be aware of. There may be concerns that you have and the effects that movements in your retirement are going to have on other things that you've not even thought about. Next question we have here is from Kathleen. What are your thoughts on using an HSA or a health savings account as a means to fund retirement? Let's talk a little bit first about HSAs and the way they work. In this week's podcast, I'm going to be talking a little bit about using your IRA to make a contribution into your health savings account. But health savings account in general are a great thing. And I encourage people to fund these. In fact, I often see people, and I think it's a good idea, that will fund the account and even still pay their medical costs out of their own pocket to allow that money to grow tax-free and then be able to use the money for medical costs tax-free during the retirement years. So I do think it's a good option. And when we look at the cost of medicine in retirement, for the average married couple, it's going to cost about $285,000 for them to cover their various medical costs. $185,000 for the male, about $150,000 for the female. So I think it's a great plan. I think everyone should put money into these accounts and start building them if they can. But remember, we want a bunch of tools in our shed. It's just like if you're doing yard work around your house, you're going to use different tools. Maybe you're going to use a lawnmower for the grass, you're going to use trimmers for the bushes, all kinds of tools to make your yard look as nice as it possibly can. When you look at your retirement, what we have is a situation that we want to use different tools. So I'm a fan of the HSA. I would encourage you, if you can, to contribute into it. Again, maybe even consider leaving your money in there versus paying current medical costs that you would have. But it should only be one of the tools. We don't want to take that account and then expect that somehow it's going to be used to cover all the various costs that we're going to have during our retirement years. We can add that to Social Security, to annuities that give us a guaranteed stream of lifetime income, maybe a life insurance retirement plan, our stock portfolio. All of these things can help us really get to where we want to be and where we should be. Andrew's question: does the Roth 5-year rule apply to every account separately or only mean you must have had some Roth account for at least 5 years? Andrew, this is for every account. So, what I recommend for people is if you are contemplating a Roth, maybe you've not done one yet, is that you set an account up. Maybe you just put $50 in it or $100 to get it set up so the 5-year period will start, and then use that account to fund each year, because what we have is 5-year rule from when the account was set up or the contribution. So if you have an account already set up that's been seasoned and you put in a contribution into the account, you don't have to worry about being subject to a potential penalty for pulling the earnings out early. Now, your contribution can be taken out at any time. It's the earnings in the account that is the problem. And they do manage these first in, first out. So your account contribution is going to be the first thing that they will look at when you pull money out. But if you do pull your earnings out before you hit the 5-year requirement, you're going to have some penalties. You're going to have to pay the government because you chose to take that money out earlier than they expected you to take it out. Well, it looks like we've got Rick with us here. Let me jump over to your question. Rick, glad to have you with us today. Pull this up here on the screen. I'm 62 and want to do more Roth conversions. Could it be a good plan to do conversions when I'm 65 or 66 when I don't expect to be working and will have a lower income? Rick, absolutely great question. And there's a number of things you want to look at. Now, we have very large tax brackets right now. So depending on how much money you're making, you may still be able to do Roth conversions in a 22, 24% tax bracket, where when we get to January 1st, 2026, which is going to be about the time you hit 65 or 66. Now, that point, you may have an extra year in there. Those brackets drop substantially. We go back to the 2017 brackets that were there prior to Trump's changes at the end of 2017. When we look at the brackets, even for a married couple, once you hit $80,000, now I assume it's going to be inflation adjusted slightly, but once you hit 80,000, you're in a 25% tax bracket already based upon those tax rates. So you want to take that into consideration when you're looking at delaying these conversions. Maybe you're even going to be in a lower bracket now than you would be then based upon where the income falls. And again, maybe at that point, even if you're not working, you still may be above that $80,000 threshold. Other thing you want to take into consideration, Rick, is the effect that conversions could have on your Medicare premiums. Now, they take 2-year look back period. So whatever your income was at age 63, that's going to be used to figure out what your Medicare premiums are going to be once you hit age 65. But if you're above certain thresholds, you'll be paying more Medicare premiums than you otherwise would have to. Now, for some people, it's not a problem. When we look at the ability to convert, we look at the effect the premiums have on the overall picture, maybe not such an issue, but these are things you're going to want to take into consideration with your own planning to make sure you're doing it at the best time to be able to get that money moved over. So I hope that helps answer your question. If you've got a follow-up question, Rick, please feel free to submit it. Very happy to make sure we get through the questions you have and we can best help you get to a more safe and secure retirement. Michael's got a question here. When a divorced spouse dies, this is on Social Security. When a divorced spouse dies, can the previous spouse claim the full Social Security benefit that was being paid to the deceased spouse? In theory, yes. Now, there's a bunch of rules when we talk about divorced spouses. I'll try to cover as many as I can here. If I miss something, I apologize. But when we're looking at a divorced spouse and their ability to get access to a previous spouse Social Security benefit, there's one main requirement, and that's they had to have been married for at least 10 years. Didn't have to be consecutive, could be over a 2 or 3 year or marriage period of time. So maybe they were married for 6 years, ended up not getting along. They got divorced, decided to get back together, got married for another 5 years, and then got divorced. That 6 and 5 year period would be added together to get to the 10. So as long as they've been married for at least 10 years, you would be entitled to those benefits, but you cannot have remarried and still be married prior to age 60 and be able to be entitled to that previous spouse benefits. If you get remarried prior to age 60 and you're still married at the time that they end up passing away, you're going to be subject to only being able to get your benefits and your new spouse's benefits. So these are things you want to take into consideration if you've been divorced, and especially if you're looking to get remarried and you're right around that 60 age period. Maybe you want to put that wedding off for a few months to get to age 60 so you don't have some issues here. Now, the amount you're going to get is going to be whatever they were receiving if you do qualify. Now, if they had delayed taking their credits or their Social Security benefits, you'd be able to get that increase that they would have gotten, that 8% per year increase. You'd be entitled to that. If they took it at full retirement age, you'd get those benefits. Other thing to remember, as we're talking through here, if there is a current spouse that is married to the individual, your ex-spouse at the time, or if they have children, your benefits will not affect them at all. So you don't have to worry about any reductions because of family limits or any of that stuff. You'll be able to get the full benefits you're entitled to there. Andrea has a question here. If you retired at 50 and live off of your retirement savings, making minimal or no wages, will that affect the amount of Social Security you can eventually receive? I'm glad Andrea asked this question because this is something that there's a lot of misunderstanding about. And we have a lot of people making wrong decisions because they don't understand the way Social Security works. Social Security takes your highest 35 years of earnings. So if you're age 50 and you started working, in this situation, 50 is a little young, but maybe you started working as a teenager and you had some great earnings at that period of time, where you had 35 high years that were inflation adjusted up to today's dollars, may not affect you too much to stop working at that point. I see it all the time more with 60-year-olds than 50, because if you got a 60-year-old that right out of college got a good job, started working, and now they're at a point that they're ready to retire and stop working, what we often find is those last few years may only increase the benefits by a few bucks, maybe even as little as $5 per month. I've seen situations where if people were to keep working additional years because of the amounts they're earning, their benefits go up very minimal. And maybe in this situation, maybe even as a 50-year-old, if you've got a job where you're not making annual increases, where those salaries are not going up on an annual basis, may not have much of an effect either. But consider the 35 years, what you've had for earnings. If you're age 50 and want to retire and have had good earnings, not going to affect you too much because they'll continue to inflation adjust the earnings you had previously. And there's no penalty. There's no last 5 years, highest 3 years, any of those that you see oftentimes with private retirement plans. They take it off those full 35-year period of time. So hopefully that answers your question. Again, if you're 60, especially if you're a sole proprietor or you have your own business, a lot of things we can do there. We run a lot of analysis for people to help them see what effect maybe stopping work would have, or maybe being able to reduce salary and putting that money into a savings account and investing it into the stock market. See, many times, especially at the end of people's working years, where they can make more money off of investing that money themselves. And part of that is too, because when we look at the way Social Security is designed, it has what we call bend points. And the first one is 90% of the first $996 that you're entitled to Social Security benefits off of. Now, they take that 35 years of earnings, they divide it by 420. This gives you your monthly amount that you're going to use the bend points against to calculate your benefits. But that first 996, you're going to get 90%. Well, the next from 996 to I think $6,002, you're only going to get 32%. And anything over that $6,002, you're only going to get 15% of those benefits allocated back into your monthly Social Security check. So what we find, especially as income goes up, and if you've had significant earnings, if you're only going to get 15% additional of what's available, that's got to be divided by 420. What we find is we end up with very small numbers there. So, and hopefully that helps you understand it. If you're one of those individuals that does want to quit early from working, but doesn't want to take your Social Security, you can have an analysis done to see the effects. But don't take retirement with I've got to take Social Security. I think that's part of the problem we have too. People get to age 62 and they want to stop working, and then they think they've got to take their Social Security early. Well, that's not the case. There's no requirement to start taking that early, and you're not going to miss out on anything else. Well, if you wait, and in fact, you're going to get some huge benefits because every year you take your Social Security earlier than your full retirement age, the benefits are going to be reduced by about 6% per year. Every year you can wait beyond full retirement age up until age 70, your benefits are going to be increased about 8% per year. So there's a big effect, big difference, especially when we look at the dollar amounts involved. It becomes a huge issue and something we definitely want to continue to look at. Looks like we've got an additional follow-up question here for Rick. Let me go ahead and go through this. Could you expand on how age 63 affects Medicare premiums? How significant are the effects? Is this year your 63rd birthday? Yeah, Rick, let me address this. Happy to talk about the way this works. So, again, they've got a two-year look back period on these. And I'm not sure what the bend points are. I can't remember them. They've got about 5 different bend points. I think by the time you get to earnings of somewhere right around $300,000, you could look this up on the internet and be able to find the exact bend points. Well, at that point, your payment that currently is going to start out for most people at $148.50 per month, it can get up to about as high as $500 per month. So it is a decent increase. You could have about 350 extra dollars that you would have to pay, but it is a year by year increase. So meaning if you did rollovers for 1 or 2 years only, you would only have those premiums increase for that 1 or 2 years that 2 years after you did those rollovers. So it's not something that you're going to get locked into forever, but that's the way that the process works. And again, it's going to be I think at 167,000, 170 something thousand, that's where your first bend point starts, where you go from 148.50 up to 200 and something dollars, and then it'll go up to 3, 4, and then it finally ends right at the top of almost $500. By the time you get there, you would pay that for a 12-month period of time, and then you would go back to whatever your premium should be based upon the next year's earnings. Why is it 2 years delayed? The biggest reason is because the IRS has got to be able to get the Social Security Administration the information from your tax return to be able to calculate this. Now, one other thing I will tell you, when we talk about conversions, they are not going to ever be able to be used to reduce your Medicare premiums. But if you maybe had a bonus from your work and it was a final bonus before you ended up going into your retirement, maybe you got a divorce, maybe you had a situation where you had some financial troubles, and if you have any of these situations, there are options for you to go back to Medicare and ask for a reduction of those premiums because of the one-time event. But unfortunately, Roth rollovers, inheritances, where you've got inheritance income, none of those are going to count to allow you to eliminate that increase in premiums that you would have over a 12-month period of time. Hopefully that helps, Rick. If not, feel free to send in a follow-up question there that we can address. Let's jump to Mike's question. Do you consider stock investments part of the tax deferred bucket since you don't pay tax until the stock is sold? We do not. So let's talk a little bit about each of the buckets here so everyone understands there's a million different ways to do retirement planning. You can put money into all types of different assets. There's a million different things you can do. The process, though, really is as simple as 3 buckets. There's the taxable bucket, which you're going to put money in there to cover your basic emergency needs. You're going to have about 6 months of basic living costs. You've got your tax deferred bucket that unfortunately most of America has the majority of their money into, that we want down for a married couple under 500,000, probably closer to 350. And for a single individual, we want under 250,000, probably closer to 175. And then we've got our tax-free bucket where everything else should stay, because if taxes are going up, we want to be able to get tax-free income. So when we look at these stock investments, they could be in any of the 3 buckets. So we don't consider it products themselves being in one bucket over another. What it is the way the income gets taxed. So if you look at it from a stock investment, you could have that in your taxable bucket. And every year you're going to get a 1099. You're going to have to pay taxes on whatever income you have off of there. If you wait for a few years to sell the asset, you would have a capital gain. In the tax deferred bucket, you've got a situation, you have those same stocks, but they're going to be deferred until you have to take required minimum distributions or you end up taking money out of those accounts. Now, at that point, they're all going to be taxed at ordinary income, not capital gains rates, as you may be able to get in the taxable bucket. And then if you have it in the tax free bucket, which you can, you're going to grow those assets, sell them, and never pay tax. So the product itself doesn't define the bucket. The buckets help us figure out how we get these individual investments and these individual products to where they're going to be taxed, what effects they're going to have on our various retirement situations. Kathleen's question, Kathleen D, is it true that if you take Social Security early and receive reduced benefits, you can pay it back at full retirement and start drawing at a higher rate? Kathleen, that is not the case. I wish it were for many people, and I know many people wish it was, because what they realize is that when you look at life expectancies, by claiming early, they've left hundreds of thousands of dollars on the table for many of them if they end up living to life expectancy or beyond. So what they do have, though, there are three options that the Social Security Administration gives you to do what they call a do-over. The first one is you have 12 months, not up until full retirement age, but you have 12 months from the time you claim for Social Security benefits, if you do it prior to full retirement age, where you can go back and do a do-over. You file a Form 521, I believe is the form that's filed with the Social Security Administration, saying, look, I claimed, but I really didn't mean to. And then you will have to pay back any benefits that you received during that period of time. So if it was only a month, maybe it's a couple of $1,000s. If you waited until month 11, submitted the form, you may be paying back, $20,000, whatever that amount may be. That's the first option. The next one is if you're younger than full retirement age, you can work at a level to where if you've already started taking Social Security benefits, the cutoff is $18,960. Once you get above that in earnings, for every $2 in earnings you make, your benefits are reduced by $1. So you could get a job that pays you enough money to where your benefits would be completely eliminated. And if that happens, then all that money gets added back in that you were taking, all that gets added back into your benefits, so that when you get to a point, full retirement age, or whenever you decide to take those benefits, you would be able to get a higher payment. And the third one is once you reach full retirement age, you can stop your benefits and start them at any time without having to pay anything back. So during the period of time, once you get there, if you've start at 67, you take your benefits for a year, that year is going to be taken off the table for your 8% annual increase. But if you say, wait, I can stop now, I've got enough money, and then for the next 2 years, you end up not taking the Social Security benefits, you'll get an 8% increase on the benefits you were taking prior to stopping. So three options there that you can take, but unfortunately, Kathleen, not one of them is the one that you are proposing there in your situation. Jerry has a question here. Can anyone convert to a Roth, or is there some type of income limit? For conversions, anyone can do this. There's no limits. There used to be, but the government opened it up to where now you can make these conversions at any time. Couple of things you need to remember if you're going to do them. Number one, I don't encourage anyone to do the conversion all in 1 year. So especially if you've got large amounts in the account. Now, if you've got $5,000 or $10,000 in your traditional account, you want to do the rollover, hey, go ahead and do it. So, but that's one of the issues, is we usually want to do it over a period of years to make sure we're not putting ourselves in higher tax brackets than we need to be. The other one that we want to look at when we're doing this on a Roth side is we want to make sure that it's really what we should be doing, that we're getting ourselves to a point that we're leaving enough in that tax deferred bucket so that we can take advantage of our standard deduction. This is something that many people overlook. They want to bring the account down to nothing, but you can leave the appropriate amount in there where you can get the benefit of your standard deduction. And the third one is if it's prior to 59 and a half and you're doing these conversions, you are going to be subject to penalty if you use any of the conversion funds to pay for the tax. So you want to make sure you have enough money in your taxable bucket to cover the tax if you're going to do these conversions, and then allow the full balance to go over. You'll pay the tax, not be subject to any penalty on that conversion. So hopefully that helps you better understand that, Jerry, and the way these things work. Kathy, why would you not want 100% of your money in a tax-free bucket? Goes back to what I was just talking about. When we look at the individual buckets, there's mathematically correct amounts we want to have in each of those buckets because we are expecting we're going to have some type of standard deduction going forward. So if we leave some in that tax deferred bucket, or maybe it's even in the taxable bucket, we've got some income coming off of there. If we leave the right amount in there, we can use the standard deduction, which is 25,000 plus dollars, will continue to be inflation adjusted. We can use that and not pay any tax. So you got a double win. You put the money in the tax deferred account, you never paid any money on it, you got a tax deferral, and then you pull the money out and you use your standard deduction and never pay tax. So there are reasons we leave money in these other buckets. Again, the taxable, we want to make sure we have money for emergencies, because what we find is if people don't have money for an emergency, oftentimes they've got to completely disrupt the rest of the retirement plan, and it can become very costly to the long-term planning that they put in place. So that's why we would do it. The other one we want to look at, though, is provisional income. We want to make sure we don't have so much in the tax deferred account that once we add our taxable income, tax-free interest income, and half of our Social Security, that we don't have provisional income and our Social Security ends up being taxed. So again, unfortunately, with a lot of this, there's a lot of planning that's got to be involved in order to take advantage of all the opportunities that are out there. But that's why people like myself are here. I've spent years educating myself on these topics in hopes of being able to help people make better decisions. That's why I do this question and answer segment. That's why I teach 130 plus webinars a year to help educate people on these topics. We do the podcast. We do all the things we do. We meet with thousands of people to go over their retirement because we want to help them make sure they're making the decisions that are going to best help them and best allow them to get to the safe and secure retirement that they're looking for. Herbert, another question here on Social Security. Not having Social Security tax assumes very low income taxpayer. What is the recommendation for taxpayers with more net worth and income? So let's think about the way we do our planning. Again, our planning is to convert things out of our tax deferred accounts into tax-free accounts to make sure we have the right amount in our taxable bucket. I've got multimillionaires that are gotten to a point where they're not paying any tax on their Social Security, but they've got to be able to be willing to pay the upfront fees of doing the conversion, and that fee is the tax. It's not fees to us to be able to do it. It's the fee is the tax to the government saying, hey, I'm going to move this money over during a period where we have historically low tax rates rather than waiting to see what they become. And by doing that, I'm also going to take taxation of Social Security off the table, which can be a huge problem for many people. Oftentimes when people have their Social Security tax, what we find is they're going to pay double the taxes they would have otherwise been required to pay. If we were to pull that Social Security out of the income that they have, oftentimes we find it ends up being half of what their overall tax burden is. And why is that? Because Social Security gets added right on top of that other income. So it does create some major issues. The other big problem is it creates a spin down of not only the tax money you've got to pay on the Social Security, but oftentimes people have to take additional money out of their 401k or IRAs to cover this tax. Well, that's going to create an additional taxable event. So they've got to pay tax on that as well. And this can cause people to run out of money 5 to 7 years faster during the retirement years. So Herbert, this is not just for poor people. This is not just for the 40% of America that only lives off Social Security. Right now, we can make changes that will allow wealthy individuals to get to a point that they can have tax-free Social Security as well, if they're willing to put in the effort to make the adjustments. And it's going to require you to think differently. It's going to require some additional education to help you better understand how it can work and why it works in your situation and what the mathematically correct amount is each year to be able to transition. Now, maybe in your situation, you've got a pension or you've got some rental property or other non-traditional assets that wouldn't be inside the stock market. If that's the case, maybe we'll never get you to a Social Security free retirement, but every dollar we can move into that tax-free bucket is a dollar you're going to save in a period of time where you don't have a lot of control over what goes on. Once you get into those retirement years, especially 70 or 80, it's really hard to get back to work, really hard to make any substantial changes that you can often do now when you're in your 50s or 60s, or maybe even into your early 70s that can really help your retirement. Well, those are the questions we're going to go through today. I know I have zipped through them very quickly. Rick, thank you for your questions. Thank you for joining us today. If you've got additional questions, feel free to join us every week here. Hopefully, well, I'm not sure. Next week, CR is still in Hawaii. So maybe it's just me again. If it is, no problem. I'll be back here next week to answer the questions you have. If you'd like to get your questions answered in the meantime, go to my website. You can just send us questions through there. If you're trying to better understand your retirement, please take advantage of the educational opportunities we offer. So much of it is free, provides you an opportunity to really understand what you're facing, especially with your own retirement, and get you to a point that you can make the right choices for your retirement. We are done. I'm out of here. Hopefully, you guys all have a great day. Look forward to seeing you again next week here on the show.